If you're paying $1 million a year in tax, you're already a philanthropist. If you have a business and you sell it, you're going to pay tax on it because the government's your partner. Why not control the good you're doing with at least a portion of that? We had a client just 2 years ago sell a business for $43 million and saved him just over $4.5 million in taxes on what would have been a $7.5 million tax bill. I would say construction. Left and right, construction owners pay more taxes than everybody. They're leaving the most on the table. You have a lot more control and a lot more choices than you realize. Tax planning doesn't have to be a series of unpleasant decisions. It can be a series of transformational decisions. And when the government raises taxes to pay down all this debt, and that's coming. That's coming.
So, welcome to Beyond the Bottom Line. I'm Joey. This is where we pull back the curtain on how the ultra wealthy actually protect and grow their money without the complexity or the gatekeeping. So each week I sit down with elite financial experts to uncover strategies that business owners can use right now so that they can keep more of what they earn and pay less in taxes legally. So today I'm joined with Mr. Carlos Lowenberg, a tax and financial strategist, author of the Wealth on Purpose series, and founder of the Lowenberg Group. Carlos has appeared on CNBC, Fox, and Forbes, and his work has been featured in the Wall Street Journal and Smart Money. So for decades, Carlos has helped business owners uncover six-figure tax savings, build bulletproof exit plans, and even use philanthropy as a tool for preserving and protecting wealth. So if you're an American business owner watching this, you're going to want to sift through that one. We're going to break down why CPAs miss these opportunities, how the ultra wealthy design their strategies differently, and the most powerful move any seven-figure business owner can do to stop overpaying in taxes. Welcome to the show, Carlos.
Thank you. Thank you, Joey. That was a nice introduction.
Awesome, Carlos. So let's start with that one. You've seen firsthand, right, how often business owners have huge savings on the table with a plethora of reasons why, right? Can you walk us back to the first time that you've realized just how widespread this problem was for business owners, specifically in the United States, and what that moment taught you about the current system?
Yeah, it was back during the estate planning when I was first getting involved in estate planning for business owners, where we were trying to do what we could to eliminate estate taxes, right?
Yeah.
So you have a 60-year-old business owner, he's going to live till he's 85, and you're going to try to get rid of $5 or $10 million of estate taxes.
Yep.
And I realized that there was so much, if you would just save some of the income taxes, you would create more than the savings you're trying to produce. And so I was like, maybe it makes sense to talk about taxes now versus taxes in 25 years.
Yeah.
And that was when I realized, there's some overlooked stuff out there, whether it was philanthropic planning or whether it was how their entities were structured, or even some kinds of retirement plans that were just being overlooked that could be tax savings vehicles now. So that was really, and this was in the 90s and early 2000s.
So was it realizing that when you were doing that work, people was often getting at it too late, and it was not that many strategies to put in place at that 60, 70 years old when it's time to do that? Or what was that moment?
It was more like, people don't plan early enough in the year, but early enough period. I mean, they've paid 30-40% of their income in income taxes, and more if they're in different states than Texas. Texas is a low tax state, right? So,
yeah.
It was that they didn't have a strategy to manage taxes. They had a business. If they're successful, normally they did that one thing really well, whatever that was in their business, construction or manufacturing, but they didn't realize that with tax planning, they could add, as much as a year's profit to their bottom line in many cases over 2 or 3 years, right? Because if a third of their money is going to taxes, and sometimes more. So planning became the key there. So sitting down and thinking about the next 3 to 5 years of taxes.
No, we're going to definitely dive into that. Why do you think, because all business owners have CPAs, right? Why do you think CPAs missed those opportunities so much?
So it used to be that we would go, okay, they're going to run this idea by their CPA, and we would sit there and cross our fingers and go, I hope the CPA sees what we're doing here and is open-minded. And
Yeah.
sometimes they were, and sometimes they weren't. But a lot of times it's because the CPA is dealing with a ton of complexities. The law has changed now to where it's almost basically it's automatic that everybody files their taxes in October
Yeah.
personally and their business taxes in September. So, I mean, you don't have a lot of time. I mean, you're looking back 9 months. By the time the CPA does their taxes in October and then takes their 2 week vacation, which they deserve,
Yeah.
it's December
Yeah.
and it's too late. So there's no strategy. Secondly, CPAs, how do I say this? More CPAs think of their business as a compliance business
Yeah.
than a strategic business. So what they want to make sure and do is make sure that the client they have is complying with the tax code and the facts and everything line up. And so that job is, and it can be very big for wealthy individuals. You know, tax returns can be 2, 3, 4 inches thick.
Yeah.
So that's really the issue, the big issue. Most CPAs who are good on the compliance side have so much compliance work, they're not doing any strategic work.
Hmm.
So it's a matter of how they run their business. And most CPAs are not strategic.
Do you think most business owners rely on their CPA for tax advice?
I think they think they're getting tax advice from their CPA and often are surprised to find that they're not. And that their CPA sometimes are surprised to find that the client wanted tax advice from them
Yeah.
on anything going forward. And
Yeah.
they give them tax advice on backwards, on the past,
Yeah.
but nothing going forward. So sort of, CPAs drive around looking in the rearview mirror because that's where their compliance work is.
Yeah. No, that's so interesting to me because again, like I think because I'm a business owner myself, right? When you get into business, you got to get a CPA, right? To help you with your books, to help you with your filing your taxes, with all that stuff. But I just don't understand why. Well, now that I'm more in that world of speaking with people like you, like I
Mm-hmm.
understand even more the value, even more than a CPA, to have a tax planner, a financial planner, someone that has knowledge with that can help you with strategy as much, if not more, than a CPA. But why do you think it's such, I don't want to say taboo, but less common than, oh yeah, you got to get a CPA, but you also got to get a planner. You also got to get a financial planner. Why do you think there's that dichotomy between the CPA and the planner?
You know, I had a business coach last year, and we were talking about tax planning, and she's very successful, and she was like, in a call with like 20 other people on a Zoom call,
Mm.
she goes, tax planning and all that tax stuff, that's a little shady to me. And I was like, wow, you're super successful. Her coach is Tony Robbins, and she's all, and I'm like, you're saying that, that's interesting. There's one perception that if we do something to lower your taxes, you're somehow maybe doing something that's not
Yeah.
right or not. I think the second thing, and that's obviously false. I mean, there's thousands of pages of. I mean, the tax law is written to help you do things for yourself, for your employees, for your community. It's written to promote the building of capital and the sharing of wealth with others. That's what the tax law does. If you don't want to do any of those things, you get to pay maximum tax. Okay. But if you'll
Yeah.
do those things, set up a retirement plan for your family, yourself, your key people, your people, set up philanthropic plans, you get to help community and help yourself. So the tax law is a reward system. It's been that way for a long time. And it's that mind, that's a mental shift, if you will, that can make it much more exciting to do tax planning than just sort of making a series of, decisions that maybe don't feel good,
Yeah.
trying to optimize your situation, right? It's all about really transforming into seeing the tax law on your side.
That's so interesting because we hear that so often from business owners that they don't want to mess with those tax strategies because they think it's illegal. Why do you think that is? Why do you think people are so scared of doing a wrong move? Is it with what's out there? Like there's so many people trying to advertise that or whatever. Like, what do you think is that reason?
Well, there are some wrong moves, right? I mean, there are
Yeah,
some things that out there that don't work or
for
used to
sure.
work and don't not work. And there's some things that the IRS is looking at abuse. What the IRS is really looking at is abusive situations.
Yeah.
But the thing is, people have taken things a few steps too far in many cases, trying to squeeze every last dollar out of a tax strategy. And when a tax strategy saves you 30% of your taxes or 40% of your taxes, going to 45 or 50 may not be worth it in that particular strategy. Or trying to squeeze a round peg into a square hole, like, as they say. There's just certain tax strategies that are meant to do a certain thing.
Yeah.
And so, and it's generally the coordination of 2 or 3 tax strategies that give you a big result. And there are firms out there who are marketing, one sort of this tax strategy does it all, and charging fees for that. And you see some of those come back. In the 90s, there was a lot more of that than there is now. I'll give you another reason too. The IRS plants articles around tax time in the Wall Street Journal and different places in order to discourage people from not filing their taxes, or from not being truthful on their taxes. Yeah, it's very interesting. I mean, the government's always been in the PR business,
Yeah.
So there's that as well, and really that's a scare tactic, and it really does scare some people away from doing just sort of normal everyday tax planning.
Yeah. So you said that the IRS, or I don't know who you were saying, the PR firms are actually, during the time to file taxes, they put some stuff to scare business owners or just the regular people?
It used to be every April or so, you could count on an article in the Wall Street Journal about somebody who didn't file their taxes, or who filed their taxes wrong, or who did something that was not legal tax-wise. And it's always a bad story. With a bad situation, and a couple of brothers took advantage of a situation they shouldn't have, whatever it is, right? And and what I was saying is that the IRS has, either they have a PR firm or they have a PR entity that does that as part of their quote unquote education to the public programs, So there is that, and I see that less now because I think those papers and things like that are less read than they used to be.
Yeah.
Everybody gets their news in different places now, but it used to be very common. You'd see somebody going down who did something wrong tax-wise. Yeah.
No, well, it makes sense, right? Because at the end of the day, it is a big revenue stream for the country. So
yeah, and I mean, the IRS doesn't like certain laws. I mean, there are laws on the books, or loopholes in some cases. That the IRS doesn't like and would like to challenge, and has challenged them and lost many times, and sometimes they've won. Or sometimes they've said, look, this is not what the law was supposed to do. In the 90s, we were doing a type of charitable planning technique, and the law was supposed to not, the law that was in place that we were using was not meant for that purpose, but it was sort of a loophole. So, and the IRS challenged it and lost. So they petitioned, through the process of making a bill and a law and all that stuff, and the government, the Congress, changed the law, and we stopped doing that particular kind of planning, and that happens from time to time. There's nothing weird about that. I mean, it's kind of like changing the speed limit on the highway. You used to drive 80 miles an hour, 75, and they lowered it or raised it in many cases. So things change.
That's so interesting, because people often think, myself included, that like all those laws and everything like that, it's all to benefit the people that create them, right? Which in that case is the government, but it's not the case, right? It's like an agreement. An agreement, it needs to be beneficial for both parties. So if you're able to find the people that can help you out with that, well, you can find what are those clauses that are beneficial to you, and that exists, right? That does exist.
Well, I mean, the laws, the tax laws and other laws. I mean, this is in healthcare too, right? The government's trying to deal with issues in society, So right now you're seeing some tax law move in the direction of helping people's long-term health.
Yeah.
You're seeing some new deductions and things that now are available that weren't available, say, 5 or 10 years ago. The government recognizes some societal challenges, and makes sometimes tweaks to the tax law to help address those, because to help people either become more responsible for themselves or responsible for others in their businesses or whatever it might be.
Yeah, you were saying that we're talking about some tax laws that are actually beneficial for the population, right?
Yeah, I mean, yeah, the tax law is a way to most of the tax law is a way to encourage people to do certain things,
Yeah,
to encourage people to put more money away for their own health care, for instance. There's lots of things happening there, new deductions or new things that are deductible. And of course, a lot of financial services, I mean, think about the retirement industry. The
yeah,
retirement industry was sort of a three-way benefit situation, right? So the retirement industry lobbied the Congress and said, people aren't putting enough money away for retirement. They're gonna be on the government. This is be on the government shoulders in the future. So
yeah.
they created the IRA laws and the 401k laws and all the pension laws so that people would take care of themselves. That's tax stuff right there. I mean, there's a
Yeah.
lot in those sections, 401 and so on. So
Mm.
409 even and things like that.
One thing that you made me think of is, and again, myself, a business owner, trying to always optimize that stuff. There's so many titles that people have: financial planner, financial advisors, there's insurance agents, there's tax planners, tax strategists. Who should someone turn to get the proper advice?
So I mean, we're a fiduciary financial advisor, asset manager, registered investment advisor, and I am the investment advisory rep for my firm that I own.
Yeah.
So, but that doesn't mean because I have those qualifications that I know taxes,
Mm.
right? So I think part of it is going to a financial advisor, a financial consultant, and understanding, hey, are you holistic in your approach to my wealth, or is it a matter of you're an asset management person, which is fine, or you're an insurance person, and both asset managers and insurance people know something about the taxes around their
Yeah.
situations. The more holistic someone can be, the
That's
better. So
great
you
advice.
really need a financial advisor who's got all of the knowledge, maybe not to the degree that a CPA might have or a tax attorney might have,
Yeah.
but has got the experience in putting together plans that achieve everything. Plans that only achieve a tax benefit are looked at more than by the IRS than plans that do something else and also achieve a tax benefit.
Mm.
This is really critical.
Yeah.
You know, we talk a lot about C-Corps, for instance,
Yeah.
and how they can be, well, what's the purpose of a C-Corp? Why does a C-Corp have a lower tax bracket? It's not just because it makes sense for big companies to have lower tax brackets. It's so that people can accumulate capital.
Mm. Okay.
C-Corps are for accumulating capital. S-Corps are for distributing capital.
Yeah.
Sometimes that's what you want. But if you want to accumulate capital, you want to have a C-Corp, especially if it's for business purposes. And there's rules around how much capital you can accumulate. So a C-Corp is already a tax advantaged, entity that's for accumulating capital. And that some of that capital can be set aside, for instance, for retirement of the owner or into some of the plans that we talk about with our, the kinds of meetings that your firm sets up.
Yeah.
Definitely needs to be part of the planning. And so somebody who knows corporate structure, we're specialists in corporate structure and business owner taxation and financial advising. Other people are really good with helping only people who are high up employees with Google and
Yeah.
different people, like, it's a little different market. You got
That's
to know
really
their
good
tax
advice.
situation.
No, exactly. Yeah, the W-2s, the high income W-2s, the business owners. I think what you said was really good. Of if you find someone that can just do one thing and push you that one thing, there might be something behind it, right? That
Right.
might not be the best thing for you. So just right away, right off the bat, if that person's not trying to push you a product and try to push you one strategy and actually looks at your whole strategy, your whole situation, and then from there, it's a sequencing, right? It's never one thing. It's not a silver bullet. It's a thousand
Right.
golden BBs.
That's right. That's right. And that's a good way to say it. There's a plan in place to implement things over time
Yeah.
that makes sense for that client. And if if you're a one trick pony, we come sometimes say, hey, if you're a hammer, then every problem looks like a nail.
Yeah.
So
Yeah.
it's better to be a whole toolbox, right?
Yeah.
Than
No,
than a
that's
hammer.
great. And you talk about the LLC, C Corp, S Corp. Obviously, the most common one that we've seen for small business owners specifically, it's LLCs, right? A lot of them have
Mhm.
opened up an LLC. And oftentimes, once they hit a certain level, a certain plateau, it makes sense for them to look at the structure. And from what I understood, you can correct me there, but a switch or a change in structure might be the number one move or one of the first moves you can do to be more tax efficient.
That's right.
When does that time come, and when should an LLC um, modify their structure in order to be more tax efficient?
So LLCs are great until you start making money.
That's a great way to put it.
And then when you start making money, moving to an S corp at some point. So I mean, I would almost say anytime you're having consistent profits in the six figures, moving
Yeah.
to an S corp, and definitely in the seven figures,
Mm.
moving from an LLC to an S corp, and then as you raise from there, maybe having an additional company that might be a C corp,
Mm.
and that really, you know, the ideal structure would be having all three entities, an LLC wrapped inside of an S corp that's also got a management company to the side that's doing management work and capital. That's where the C corp might be pulling in more capital with management fees.
Understood. That's really tactical. That's very good. I know that we've talked a little bit behind the scenes and stuff. Is there any case that you can remember that you discovered the biggest amount of like hidden savings through tax strategy that you would be willing to kind of share how you discovered that? What was the strategy implemented, and how much were you able to save for that specific business owner?
Oh yeah, yeah. I mean, I would think about two different cases. One is client making about $8 million a year, and they were an LLC. Well, they were an LLC, but they began to be taxed as a C corp, and so and he was paying himself a salary of about four now. So keeping 4 million inside and paying himself four as a salary, which that was the S corp may have been a better deal there for his salary part, and the C corp it would have been nice to be split. But
Yeah.
what we figured out was that for that particular year, um, the best thing for him to do, with his goals in mind, was to give a small part of that C corp away
Okay.
to charity. So the C corp was probably worth about $60 million at the time.
Okay.
And so what we did is we had him go ahead and bonus himself out most of the profit the next few years, but we attached that to a $6 million charitable gift
Okay.
that went into a trust that allowed him to buy back little bits of that C corp over the next 25 years
Hmm.
with excess cash flow. But the $6 million, he got a $6 million tax deduction,
Yeah.
which he couldn't use the first year. He couldn't use all of it. He could only use about 2 million a year. But he was able to pull $6 million out of his company the next 3 years. I'm sorry, $8 million out of his company the next 3 years, but only pay tax on six with that one strategy. So that saved him about $1 million a year in taxes.
It's crazy.
So $3 million of taxes plus that little bit of the company that was in the charity, the charitable trust was
Yeah.
paying out to his family's foundation. So as he was buying that back at like $60,000 or $70,000 a year, not a lot, that money was going into his family's foundation, which was doing things that he wanted to do in the community. So that was kind of an interesting um, plan, and we coordinate that with his estate plan so that at estate tax time, his trust would buy back that charitable piece of the business with some life insurance he had in trust, and the charity would be totally funded. And so, pretty attractive to give away, about 10% of your business to save about 30 or 40% of your taxes for several years. And we did that twice for him. And that's a business that he's passing down to his kids.
Mm.
The other big place we've saved money, we had a client just 2 years ago sell a business for $43 million. And we did a structure sort of like this. We used a charitable trust. We put 23 million of the 43 million into three charitable trusts actually.
Yeah. And
saved him just over $4.5 million in taxes on what would have been a $7.5 million tax bill. So he still paid three. And we dealt with that other ways. We chipped away at that with other plans, but the big one was that charitable trust. And now he's in control of all $40 million, as opposed to just being in control of 35 million. So makes a huge difference in what you can achieve. I was just featured in an article in USA Today where I talk about some of the planning like this, and it just came out about 2 weeks ago. And we show some of the math behind planning like that and how much more wealth it can add to a family and their heirs, of course.
That's so interesting. By the way, send me that link. I'm going to put in the description so people can watch it after this interview. But that's so interesting. And I think that's where you talk about using philanthropy, obviously for the right reasons, for the right thing. But if you do it properly, you're able to chop off so much tax savings from that. But why is that the case? Why is the IRS putting so much emphasis on philanthropy and letting you save a lot of taxes on that?
So the philanthropic laws have been here basically like they are now since 1969. I mean, there was laws before that. I don't know them, but I think that they limited some of the gifting basically in 1969.
Yeah.
And there are people that think you can make a charitable trust donation and not pay any tax, and that's not true.
It's not true.
But you can cut your taxes down by half generally if you've got high income. And the reason that, this country is sort of founded on the idea, and all Western countries really have this baked into their tax codes now, on the idea that if you'll help society, we call that social capital. If you'll defer or direct some of your social capital to helping less fortunate or helping things that the government wants help, whether it's build hospitals, we've had clients build hospitals, we've had clients start food banks, we've had clients, do things for emergency situations all over the world. The government wants more hospitals across the country. The government wants better care for its citizens and isn't going to pay for all of it. So that's why philanthropy is part of the core of our tax laws. Yeah. And the way we think about it is we think about, look, you've got an opportunity. If you're paying $1 million a year in tax, you're already a philanthropist. You're some other things too. You're helping you to pay for wars and other things too, but you're doing some good with that $1 million a year in tax. And how much good is a political debate, right? But you're doing some good.
Yeah.
Why not control the good you're doing with at least a portion of that? And so we're repositioning taxes, that social capital. If you have a business and you sell it, and you'll experience this one day, and you're an American citizen, you're going to pay tax on it because the government's your partner.
Yeah. And
I think it'd be more rewarding for a charity, maybe your family foundation, to be your partner, or at least one of your partners, right? Well, let's diminish the government side of the partnership and increase your family side of the partnership. That's really what's happening, because every dollar you make, you've got a partner in. And when the government raises taxes, which they will in the future to pay down all this debt, that means they're going to be a bigger partner in your financial life. And that's coming. That's coming, right? So let's direct that and control that.
That's so good. Yeah, because you're already giving that money away. It's just a reason for you to kind of choose at least a portion of that where you want to put it, the causes that you actually care about, and not just let that in the government. And knowing that the government is actually okay with that, right? With tax laws, well, it's something to definitely explore.
Yeah, that's right.
What's the level that a business owner should start exploring that? Is it once they making $1 million profit a year, 10 million profit a year, 100K? Yeah. What's the levels?
making $3 million a year in New York City is different than making $3 million a year in a little town in
Texas. Yeah.
Texas. Yeah. Okay.
Yeah.
So, this article that I'll send you,
Yeah.
deals with this a little bit, because a lot of people worth 20, 30, $40 million think they'll ask me, am I rich enough to be doing this philanthropy stuff? I'm like, oh my gosh, because all
Yeah.
you see is billionaires everywhere,
Yeah.
right?
Yeah.
Anymore, right? It's the billionaire class is 5 times the size it was 10 or 15 years ago. So
Yeah.
it seems like they're everywhere. And those are the people that this is all for.
Yeah.
I
That's not
mean,
true.
it's not true. It really makes sense for anybody who's paying more tax. So two things have to be the case. One is they're paying more taxes than they'd like to be. They'd like to
Yeah.
control some of that social capital and direct it. Number two, they're not spending everything they're making.
Yeah.
So like if you're making $1 million a year and your personal expenses and lifestyle are $1.1 million, philanthropy is going to be tough on you. Might still work,
Yeah.
but you're not going to get ahead as easily. But if you're living on 500,000 and you're making $1 million, then definitely. Or if you're living on 200,000 and you're making 400,000, then you're paying a lot of tax on money you're not spending.
Yeah.
And so tax planning makes sense. Philanthropic planning makes sense, but tax planning makes sense. But if you're spending more than you're making, tax planning's tough.
Mm-hmm.
And philanthropic planning is the level tougher.
Yeah, for sure. No, it's what we said. I think it was Russell. We were talking with him on one of the episodes. There's the top line, there's the bottom line, right? And where we want to take the show beyond the bottom line, which is what you get to keep, right?
Yeah.
I think at the end of the day, that's what's the most important. It's whether you make $1 million. If you spend a 1-1, well, you're still poor, right? And you cannot do anything with that. So it's what you keep, and the more that spread is high between what you make and what you get to keep, well, the more taxes you're going to pay. So how can you decide where that social capital go? I think that's very, very interesting what you're talking about. I'm curious to know again, because we've seen obviously there's different industries, there's different types of business owners, different specialties. I know you've dealt with multiple industries over your decades of experience. What types of businesses or industries, from what you've seen, leave the most money on the table with those proactive tax planning strategies?
So I think if you're saying what's the question is, which companies,
what types of businesses or industries leave the most money on the table?
Yeah, I would have to say construction.
Construction.
I would say construction. Left and right, construction owners pay more taxes than everybody. Well, I think, I've thought about this. I mean, I really think it's because construction businesses leverage manpower.
Yep.
And then some debt, but really especially larger construction companies, they leverage manpower and they leverage capital. So in fact, I was on a call yesterday with a client who's a construction company, and we're working out a sale to one of his key people of the business.
Yep.
And he was like, I know I've got a lot of, and I know I keep millions of dollars, and you saw that on my balance sheet in the business, but sometimes I need that, and here's why. And he kind of went through this explanation. He goes, I can't, part with that or put it somewhere where I may not be able to access it for something I'm doing for the city or for this mini hospital we're building or whatever it is. And so they need capital, and they need capital for their projects, but they also need capital oftentimes for their bonding. So if you're familiar with bonding, but basically, bonding. So bonding is a type of insurance, basically, that if you're a big time construction company and you're doing big time work, building highways and big buildings, the developers of that need you to be bonded, meaning that they need to have a guarantee that if something happens to you as a company or you as a person, they're going to get the money to keep doing the project. Yeah. Or they're going to have that project. That project sort of like guaranteed. Collateral. Yeah, it's sort of like a guarantee that you'll finish the project. It's a bond. And they go out and buy bond insurance, so they got to be bondable. A bond insurance company wants to know that you've got plenty of capital. So they're looking at your finances and things like that, and your reputation, of course, and all those things as well. But capital is the big one. Do you have millions of dollars that's going to back you up as a business for this project? Because we all know projects don't go the way they're supposed to go. So that's part of it. So yeah, so it's construction companies. So they're less willing to do strategic planning because they're so tactical. But if they would do strategic planning, tax planning, they'd have more bondable capital. They'd actually have more capital.
Mm.
But it takes a thoughtful approach, and they're maybe the mindset's just not there. But that's what I see. This is the construction
Yeah,
industry.
because they do. It's so the industries that needs a lot of capital and needs it quick are most oftentimes the one that would suffer more from that. Do
Yeah,
you think though it's a limiting belief on their end? Can they change that, or is it
yeah.
just the industry that's harder?
No, it's definitely a limiting belief. I mean, it's just that it's because it's a pervasive belief across the industry. Construction companies tend to do what other construction companies do.
Yeah, yeah,
Because they all talk to each other, working together. You got a general contractor and a subcontractor, and those two people know each other, and
yeah.
so it's generally like that, and that's they're leaving the most on the table. And there's not, um, there's no reason for that. It's just I understand their concerns, but we could create more capital on the balance sheet if that's what they wanted, with some structure and some tax planning, and the use of the kinds of products that we sell.
Hmm. What are the top three blind spots that you see with traditional tax prep that cost business owners the most amount of money?
Um, I would say, okay, so we talked about one, this overlooking philanthropy.
Yeah.
That's number one. Number two, overlooking the types of benefit plans that are available to themselves, to their key people, and to their companies at large. You know, if you ask a business owner, hey, if I could show you how to put $200,000 away for yourself, but you got to put $30,000 away for the rest of your employees, would you do it? They'll go, yeah, of course I would,
Yeah.
tax deductibly. They're not doing it.
Hmm.
And you would think that their CPA brought them that idea, or some retirement plan person, expert, or whatever, but they haven't. So they overlook those things. Or, if I could put a plan together for you and your key people, to retain them long term, your key people especially, and it was deductible, or it basically cost you nothing because of the tax benefits,
Yeah.
would you want to explore that? Of course they do,
Of course. Yeah.
but they're overlooking that. And then I think the third thing that they're overlooking is all the little gimmies, from the government. Like, I have a client in Colorado who basically rewards his employees in many cases with, they go get to stay at his second home in the mountains,
Okay.
and that costs something. And that second home is a nice, I mean, it's a nice place, right? Well, he can use the Augusta rule, for instance. I'm sure you've heard of the Augusta
Yeah.
rule, the 14-day rental thing, and be getting a write-off for that,
Yeah.
uh, for that benefit he's providing. And those things are overlooked. I mean, there's all these little uh, benefits like that but they'll probably put another twenty to $40,000 in someone's pocket. But that's all right,
Yeah. I know.
So I think those are the three. If I had to, if I thought about this a lot longer, I'd probably think of a better answer for you. But that's what I think.
That's often what we see, right? It's philanthropy. That's definitely something new that I've learned today, and I hope a lot of people
Mm-hmm.
learned as well. But oftentimes it's you don't know what you don't know, and I think it's even more true in this tax world in the United States. Things changed, and it's often those little rules specifically to your situation, depending on your profits levels, your revenue levels, your industry. There's a way to make it work, right? And there's definitely a way that you can pay less than what you're currently paying right now, if you haven't worked with a proper tax planner, proper financial planner, or someone like you that could help them
Yeah,
with that.
yeah.
How does the discovery process looks like whenever you meet a new business owner that wants to, things are overpaying in taxes, right? They want to pay taxes because they want to be in total legality, but they might think that they could pay a bit less, right? What's your typical process, and like how long does it take before you can see significant savings?
I mean, we generally get significant savings in the first year. because we'll introduce things that are big in the first year that we work with them,
Okay.
and then we'll do structure. Like if we meet somebody right now, we can get work done by the end of the year that will save taxes, and then we'll put structure in place that's sort of an ongoing tax savings through the course of the future years. Um, our discovery process is kind of twofold. I mean, so you want to save taxes, great. For what? I mean, I know it sounds like a weird question, but of course I want to pay less to the government, right? Yeah,
Yeah.
but what are you really trying to achieve long term? I mean, when you look back on today and the next 3 to 5 years, and we put an extra $1 million in your pocket, what's it for?
What do you want to do with it? Yeah.
Yeah, what's it for? Is it so you can retire earlier than you planned? Is it so that you can pass more to charity? Is it so you can give more to your kids? Is you got something you want to fund? Um, what is it? And so that's really it's really to try to isolate the owner's self-defined purpose,
Why is that important? That second layer of knowing what you want to do with those savings.
because then we can begin to build something that's transformational. Meaning that the business owner. Let me back up a little bit. The the issue with tax planning or like estate planning, I was talking about at the beginning of this
Yeah.
conversation, is that it's a series of unpleasant decisions made to minimize the damage,
Yeah.
like, okay. And that's what tax planning has become too. Like, oh, let's do this and complicate my life a little bit so that I pay less taxes. And man, and some guys are just like, man, I don't want to do that.
Yeah.
Well, the reality is you're using a set of tools you haven't used before. And if you think about it like that, um, then this can be transformational. This can be really positive. Let's go do some good for yourself, for your employees and family, or whatever is next on the priority list, and for community. Because the tax law doesn't have to be your enemy. It doesn't have to be a series of unpleasant decisions. It can be a series of transformational decisions that let you control more, that give you more wealth, give you more control, give you more satisfaction, and give you more impact on the things you want to impact. So that's why that question is important. I'm dedicated to transformation. And if I talk to somebody and they're not on that same page or don't want to get on that same page,
It's not going to work.
that's
Yeah.
probably it's not going to work. We're not the guys for them.
Hmm. Understood. No, that's really good. So I think tactical advice there. It's everybody wants to save taxes, but do that extra work to see what you will do with that, right? If it's for selfish reasons, and it's for selfish reasons, right? Everybody would like to keep more money in their pockets, but
Yeah, it's
knowing what
not
that is.
selfish to because you're going to do. I mean, the tax law generally is going to promote you being unselfish. It's just
Yeah.
we're just redirecting money that's going to go to taxes
Yeah.
to some of your favorite causes, even if that favorite cause is your family.
Yeah. Yeah. Which most of the time
It
is
is.
right for
Yeah,
most
it
business
is.
owners. Yeah,
Yeah.
that's so good. I'm just thinking about what you said about that. That was so good. What you the IRS doing PR during the times of
Yeah.
tax season to
Yeah.
scare people away. It makes so
Yeah.
much sense, right? And
Yeah.
that's what oftentimes create that whole skepticism around being all good and making sure we're all doing the right thing. Um, how do you ensure that like the strategies that you implement remain IRS compliant and audit proof while still being able to get those maximum savings?
Almost everything we do is codified, meaning that it's a law.
It's in the code. It's in the
It's
tax
in the
code.
code, right?
Yeah.
So um, the issue isn't doing it or not doing it; it's doing it wrong. And
Yeah.
but there's steps you put in place. If you're doing a charitable trust, you need to value what's going into the trust. Have a certified valuation that's what's going into the trust. If you're doing retirement plans or deductible, pension type plans and those kind of things, well, there's a lot of checks and balances that go in place. They're actuarial and everything else. And there's firms that we partner with some of the best firms in the country in all these different areas. And it's really not that difficult to stay in compliance. You got to have a good CPA. I mean, there are plenty of CPAs who just this is not their bailiwick. This is not where
Yeah.
they should be practicing or aren't practicing.
Yeah.
Um, a good set of tax attorneys, but the legal field is so the CPA world is sort of going through some really tough challenges right now as businesses. It's really a hard business. The deadlines are mismatched and everything else. But the legal world, AI is changing that to be something that is much more affordable, doable, attainable by everyday business owners. So um, there's a lot there. That's a big part of it, is just getting the right team
Yeah.
involved.
I think you nailed it. Yeah. Like if it's in the code, if it's in the law book, then it's good, right? You know it's
Yeah,
good. And it's
yeah,
it's only now doing it right and the execution that has to be right. So looking at
yeah.
someone's accolade, looking at someone's experience, looking at some case studies, some past results, then there's really no fear that
Right.
should be there to implement
That's
that
right.
type of
That's
stuff.
right.
Hmm.
I mean, when I was first in business, 401ks were controversial. Okay, that's how long
Yeah.
I've been in business. Okay, they were like, "You can't do that." I'm like, "Yeah," and
Yeah.
CPAs
Yeah.
were telling us, "You can't do those." I'm like, "Yeah, yeah, you can," but not that I was trying to push 401ks at the time. But I'm like, "Yeah, it's just as good." It was new in 1978, and still in the early 90s, people weren't quite sure it was doable.
Yeah.
Just this last few months, we've had CPAs tell us you can't do pension plans for 2024. You got
Yeah.
to have everything signed in 2024. Well, that changed during COVID, right?
Hmm.
But they didn't know. They weren't up to date on the tax laws. The tax law says you can decide right up to the last minute to do a pension for, up until you file your taxes for the previous year. Now, don't
Hmm.
wait to the last day because you need a few weeks to. But really, that's the case. So not everybody's up to speed on everything,
Hmm.
certainly, and I can't fault them. It's a complex and moving, growing body of work. The tax law.
How do you stay updated with all that stuff? Is it your team? Do you research that? How does
So
that
I
work?
that's my job is research and thinking about things. And that's my first job. My second job is to implement it. And so
Interesting.
that's the way I see it. I don't see it the other way around. Um, and I've always told people, look, I want to have the sharpest axe before I go cut down that tree. It'll be easier when
Hmm.
we do. And so I do a lot of research. The second thing is I'm in a specialized area. Like I couldn't, like we talked about other markets, that have W-2 and are maybe high W-2 and maybe have stock uh, RSUs or stock options or whatever
Yeah.
warrants with the kinds of tech companies that are around here. Right now, that's not my clientele and hasn't ever been. And so we really know the bit of the tax law that corresponds to our clients' issues. So our client our clients are in 2% of the population is in our client potential in our clientele, and basically 1%.
Yeah.
Um, and then out of that 1%, only half or maybe less than that 1% are actually big enough to work with us long
Yeah.
term. So we're really a specialist in a very small part of the population and their issues. And so I don't have to know everything. I have to know everything about them.
About them. Yeah. It's being niche into
Hmm.
that, like the customer you serve. Um,
Yeah.
that's really good. Let's say I'm a business owner making between 1 million to 10 million, right? So seven figure bottom line. Okay. So
Hmm.
profit. How can I self audit for missed savings? And where should I start if I know I can do better? Where do I start into self auditing? Okay, like what are the places that I could save money on taxes?
So most business owners that you described in that are giving some money away. Actually, they're doing a little bit of charity. They're probably not getting to write it off because it's not the right. They're not doing it the right
Not the
way,
right way.
or the
Yeah.
or the right structure. So that's number one.
Hmm.
Number two, if you've only got one entity that's doing all that income, you're missing out. Okay, it's because the use of more than one entity is a structure that
Yeah.
could save you money. Um, So it's time to look at second structures as a tax saving vehicle, but also it does some asset protection work for you. It does some, you can do some management stuff for you. You get other types of deductions that you can't get in your LLC or your S-Corp that you're probably in. The third kind of area to self-audit is, have I professionalized, have I done the things for my key people and my most valued employees? Am I getting deductions for helping them build wealth? And there's all kinds of things, from non-qualified plans to qualified plans, that can be geared towards sort of the most important people in the business, including yourself as the owner.
Yeah.
And then another area that I would audit is, we mentioned this. Where are all the little gimmies from the government that I know I get? Like setting up a 401k, which is, gives you $1,000 per employee in credit, tax credit.
Yeah.
So if you got 40 employees and you got $3 million bottom line, you can get a $40,000 hit, right? I mean, just, it's free money.
Yeah.
The government is giving free money in many cases that people are just missing.
Yeah.
And so, because they don't think that it'll be well received or whatever the case is, doesn't matter, and you don't know. So there's certain things that are like that are just, the Augusta rule we talked about. There's always little things like that really you don't need a professional tax planner to come in and tell you about, but you need somebody to give you a roadmap on. We give all of our clients free. Hey, here's 3 things you can do that will save your taxes, even if we never talk again. The Augusta rule, how to use it, what you're doing in pension plans, and structure. And we give some value weight there because really that's what they need. It's just a little checklist and a operations pamphlet on how to do that. There are some people out there charging, $4,000 a month as tax planners and doing that. And it's really just a handout.
A handoff.
Yeah. It's really all it is.
No, that's amazing. That's amazing. Because again, I think all the information's out there, especially with AI, ChatGPT, all that stuff. It's out there,
Yeah.
but the value's in the implementation, and
Right.
it's the likelihood of achievement, right? What's the likelihood of achievement? And you get that through proper roadmap and someone explaining to you the exact steps in order to take to make sure you don't screw up and you don't do something wrong. Because that's the risk of that is trying to do it yourself, and then something happens, or doing with someone that maybe doesn't have a certification, and that's where you can get in trouble. So getting with someone that really has a track record and gives you the roadmap, just implementing that stuff, that's the easy part.
Yeah, that's right. That's right.
If you could give one action step to a business owner watching this right now to stop overpaying in taxes, like one step, what would it be?
Besides call me?
Besides calling you. That's the easy one.
That's the easy one, right? I would say go back to your vision for why you started this business and the impact that you wanted to have on yourself, on your people, on your family and community, and why this was important in the first place. And see if you can align your financial wherewithal, your financial world planning and tax planning with that purpose. Because if you've been in business for 5 or 10 years, and business is hard, and you kind of lose sight sometimes of why you got into it in the first place.
Yeah.
And so I know that's a big first step, but that begins to bring you back to having it builds the vision, and it makes it, complexity is generally complex because there's things you don't want to do.
Yeah.
But things that you want to do are very simple. They're very simple. And so, because the energy's there. And so things need to be simple. And if you don't want to do it, it's not going to be simple.
Yeah.
If you don't want to do tax planning and you're doing tax planning just because you want to save some dollars, it's not going to be simple.
You're going to hate it. Yeah.
Yeah.
That's really good. That's the biggest takeaway I got from this conversation, is even for myself, I'm going to do that right after this call or this weekend, but really find some time to really understand the reason why, right? Like, why do you want to do this? What do you want to do with that extra money, right? Because, okay, it sounds nice to save some money on taxes, but what are you going to do with it, right? And I think getting aligned with that North Star not only help obviously with those tax strategies, but in your business in general, right? Because I've been in business for 5 years as well. And oftentimes, like you said, you're in the day to day, you forget about the reason why. There's problems every day that comes up. It's like, what's that North Star again? And sometimes that North Star changes, right? At 20 years old, at 40 years old, you have different goals, you have different responsibilities. So I think that's a very great tactical step that any business owner should do if it's not clear what's that North Star. I think that guides everything else, that compass for where they want to go.
Yeah. Yeah, that's exactly right.
That's amazing. That's great. Well, Carlos, I'm going to ask you the final question, which is the recurring segment. We call it the legacy question, which is if this episode outlives you, right? In hopefully multiple decades, what's the one lesson that about building and protecting wealth and saving on taxes that you would like every business owner to remember from this episode?
That's a good question. I think it's that you have a lot more control and a lot more choices than you realize you have. And even when you hire someone as good as us at this, there's still more choices and control. And because you have the choices and control, like you've demonstrated by building this business, and because the tax laws were written for people like you as a business owner to do good in the world, meaning family, employees, and community, that gives you an array of choices that most people don't have, and a chance at impact that very few people have. And so I don't say this as a weight on your shoulders. I say this as motivation, as a clear and present why to go forward and to enjoy it, because helping people, everybody we talk to who's a business owner, I mean, I love my clients. They want to help people. Period. And so you can do that. You have the choice, and it can be the impact is so rewarding. Not because I'm not trying to compel them to be that, like that they have to. I'm like, no, this is your choice. But that's my point. It's your choice.
That's a beautiful answer. Carlos, thank you for your time. That was an amazing episode.
Great.
If you're a business owner watching this and you found this conversation valuable, all I'm asking is that you subscribe to the channel, comment what was your biggest takeaway, and there's going to be a new strategy-packed episode every Monday. So make sure you guys chime in and you're here for the next one.